Where Lululemon shares are up around 5% after beating on the top and bottom line in their Q1. But guidance for the current quarter was weaker than expected. A slowdown in North America was one of the headwinds there. And my next guest calls the report better than feared, but says profit margins are still lagging, markdowns are getting worse, and it's making him wonder if the brand is overstretched. Joining to discuss, Simeon Siegel is senior retail analyst at BMO Capital Markets. Simeon, it's great to see you.
Good to be here, Kelly.
Is it as simple as they're off trend now and denim is winning?
I'm sure plenty of people a lot smarter than I am would say the answer to that is yes. I'm not your fashion analyst. All I know is if I were to delete the word Lulu and show you the report that just came out last night, you would tell me it looks like the bottom of the pack for retail reporters this cycle. Lulu has been the outperformer forever, and give them all the credit in the world. It's a fantastic brand. What they've done is tremendous, but you and I are used to talking about them as being the top of the pack, the best story in retail. And last night's gross margin just lags the group. And that raises questions you and I have to ask when you're at this size.
So in other words, in the past, they could basically put a price, whatever price they wanted on their clothes. They were so in demand, people would snap them up, even if it was $118 for, some of their beautiful yoga pants and whatnot. Now, all of a sudden, they can't move the merchandise without significant, it sounds like price cuts or lower. Because why? Because it seems like the customer, again, this is my interpretation, their mind is elsewhere. They're not as excited maybe to buy that Lulu fashion. What is the company saying about what they think is going on here?
So I think the company rightfully would point out that their America business still grew. And so at the end of the day, it's not that people are running away, right? It's what's the cost to drive that? And so I want to be really clear. Lulu's going to get a big knock and say, oh, there's a problem with the brand. And I think the question is simply, did the brand overstretch? You and I forever have talked about brands have ubiquity levels. They have levels where the consumer starts, for lack of a better word, seeing them as less cool. When that happens, they can drive revenues, but it comes at the cost of margin. It comes at the cost of profit. It comes at the cost of brand health. That's what I'm looking at. And so conversations around denim no longer being skinny means there's no longer a reason to buy leggings. I mean, Lulu's revenue volume they just put up would argue against that. But when you and I are talking about paying up for a stock, when we're thinking about what should this company be worth, when we're thinking about what is the brand worth, that dreaded word, that markdown word that they brought up last night, which you're referencing, all that means is it costs them more to sell the same.
Yeah, exactly.
That is something we look for before brands hit that peak.
You've made a point. Look, to kind of contextualize this, you think Lulu's at an important crossroads. And in fact, they've already done quite well. You said the healthy level for brands and where they peak is around the $3 billion mark in America. Lulu is double that. Okay, so the question investors have to ask themselves is, well, how much retrenchment? If Lulu sales were a technical chart, where is that? Where are they trying to put in a floor or a bottom now?
Yeah, and listen, technicals are beyond my intelligence scope as well. But I think you're exactly right. What we do know, for whatever reason, most brands are healthy at $3 billion. When they go above, they stretch. Now, it's not. There are exceptions. Nike's a dramatically larger business, but Nike has a lot of other things that Lulu doesn't. Lower price, higher marketing, footwear, there's a lot of different compelling reasons, and ultimately more brands. I think what they need to figure out, this is still, right, looking at where the stock is, it's come down a lot if you're talking about charts, but still roughly $40 billion of market cap for a business that's doing $10 to $11 billion in revenue. That's a big discrepancy. That's kind of historically VC levels of valuation. And so I think what we do need to internalize is we're talking about a stock. I think the brand is strong. The brand's done a nice job. If the brand becomes less strong, if that equity becomes lower, we start looking at that gap. And that's a big delta between there if you think about a lot of where these other businesses trade. Yeah. And so I think that's the question we're going to answer when I look at this. If I can't pick Lulu out without knowing its ticker from the results, then should I pay more for it than I would for those other businesses? That's ultimately our biggest question right now.
Yeah, very good point. I think at this point your target are you still above the market, but you got to bring it down or wait and see a quarter or two?
So listen, I think right now we're at 25 times. That's our price target right now based on where the street is. It's closer to 20. If Lulu has brand equity, 20, 25 times, we'll have risk. If it does not, then people will say it used to be 30, used to be 35. And so that's why your point at the crossroads, what we were talking about, it's really important to see what the next step is. And if Lulu can show that Americas continues to grow, then international will give them plenty of room. Yeah. If America starts to decline, if we start seeing this brand push too far, then we're going to see that multiple come down as well.
Very well put. Simeon, we'll check back in soon. Thanks for your time today. Appreciate it.
Good to see you.